Welcome, everybody. Good afternoon, good evening. Thanks for joining us today. We have a great mix of clients and what I call friends of RGB Capital Group on the call with us. For our clients, this is part of an ongoing dialogue on how we manage risk in our portfolios. It allows them a chance to do their ongoing due diligence to make sure that the services that we provide are still meet their goals and objectives. For those that are newer to RGB, this is not a sales presentation. It's an opportunity to understand how we think and how we approach the markets, particularly during uncertain times. And given today's market environment, which feels a little more less certain than it has in the past, we felt this was a timely moment to kind of step back from all that noise and talk about discipline, talk about our process, and talk about risk management. Before we begin, need to cover a few standard disclosures. Our compliance folks asked us to do this, so here you go. Thankfully for all of you, I will not read this word for word, but please take a moment to review it. All the materials will be available to you after the session. With that out of the way, let's go ahead and get started. So why are we here today? We wanted to take the time because the market environment has become more challenging to navigate. Certainly, volatility has increased relative to, say, the last summer, which the markets were pretty calm. Leadership has shifted. We've seen small caps, mid caps, even value stocks are starting to outperform large cap and technology stocks that have outperformed for many, many years. We haven't seen small caps in a leadership position for quite some time, so that's certainly different. And there's certainly no shortage of confident opinions and forecasts about what's coming next. There's a lot of folks out there that are claiming doomsday is right around the corner. Others are suggesting that we're in for great economic times. So in periods like this, investors are often tempted to react. They want to chase what's working and avoid what might feel uncomfortable. Or they might abandon a disciplined approach exactly at the wrong time. So today is about stepping back from the noise and talking about how we manage risk and maintain discipline when conditions in the marketplace start to change. But before we go any further, I want to be clear about what today is all about and what it's not. As I said before, this is not a sales presentation. It's not a short-term market forecast. We're not here to make any predictions about the market, where it's headed, or what's coming next. There's plenty of folks out there that do that. You certainly can follow them if you want. My experience with predictions and forecasts are they're generally wrong. A lot of those guys change their forecasts midstream as conditions change. So we try not to play in that sandbox. But what this is today is more about an ongoing dialogue, especially for our clients, about how we think about markets, how we approach risk, and how we manage portfolios when conditions are less certain. And that could be in both up and down markets. Markets will always be volatile. The question is whether investors remain disciplined when conditions change. I want to start off by talking about volatility and risk management and how that shows up in the markets and how we think about managing it. So we're going to start with the discussion about volatility because that's the most visible way risk expresses itself. This is a chart of the S&P 500. Goes back to early 2000. And I want to start with the basic reality that the markets have always been volatile. You can see this repeating pattern. The market goes up and it pulls back. Goes up and it pulls back. So declines of 10, 20, 25, or even 50% are not anomalies. They're part of the fabric of being invested in the market. Each of the declines you see on the screen here were driven by a different set of circumstances, different root causes, different headlines driving the news, but the same end result. So the question is not whether volatility will show up again. That's for certain. We will always have volatility in the stock market. The question is how we prepare for it and how we stay disciplined when that happens. Unfortunately, these declines are not predictable. Never have been, they never will be. They usually come out of left field somewhere. as you can see here, we are at all-time highs. This chart happens to go through the end of last year, 2025. Well, the stock market has continued to trend up a bit here in first month of 2026. So we are still at or near all-time highs. I can't tell you if the next bout of volatility will be next week, next month, or next year. However, this is a great time when the markets are more stable to make sure that we have a disciplined process in place to deal with whatever happens next. And that kind of leads me to a discussion about our risk management philosophy, so we can deal with the volatility whenever that might happen. And my first rule of investing is, you can see here on the screen, avoid steep losses. This is a bit of a play on Warren Buffett's rule, which he said his rule number one is never lose money. Now, I personally don't believe that is a realistic goal, because we can't avoid all declines in the market. We will always have declines at some point. What we really want to do is miss the really, really big ones. And that is achievable as long as we can implement strategies that'll help us avoid those steep losses. And that's our focus here at RGB Capital Group, is really to help avoid those steep, large, life-altering losses in our portfolio. And so why is that so important? It's not really because volatility is uncomfortable. It's more because large losses really change the math. On this chart, this gray shaded area here represents the losses that you could incur in your portfolio. The orange area here represents the gain required just to break even. So a 10% decline requires an 11% gain to get back to break even. It's just simple math. However, the deeper you go into the hole, the harder it becomes to recover from those losses. For example, if you had a 50% decline, it would require a 100% gain just to get back to break even. So if you think about it, you had $1 million portfolio, you lost 50% of it, you now have $500,000. It would take 100% gain, or another $500,000, just to get back to where you were. So there's certainly an opportunity cost to these steep losses, because coming across a 100% gain isn't all that easy. It doesn't happen immediately, it takes time. So if we can avoid those types of large declines, we can spend more time creating new wealth as opposed to recouping losses. Anyone who had been invested during the tech bubble in early 2000s, if they had a heavy allocation to tech stocks, might have experienced a 75% decline. That would require a 300% gain just to get back to break even. And that would be very challenging. And what's worse is that people who are in retirement, the math gets even more troublesome if you're withdrawing funds from your portfolios to support your living. The math there is pretty simple. If you were taking out a sum of money from $1 million portfolio, and now you're taking that same sum from a $500,000 portfolio, that sum now represents a bigger portion of that portfolio. And therefore, withdrawing funds from your account during steep declines has a dramatic impact on your financial future. I wanted to introduce this chart. This is called a drawdown chart. This chart shows drawdowns, and a drawdown is simply a decline from a prior peak. This is a drawdown chart for the S&P 500 index. You can see here it goes from 0, negative 10, 20, 30, 40. If the market's at a peak, it flatlines here at 0. It doesn't show those increases. So the purpose of this chart is to really highlight the drawdowns in the stock market. So in early 2000, we had the tech bubble. It pulled back 50%, had a really nice recovery, got to a new peak. You can see it flatlined here, only to turn around a few months later and start to decline into the great financial crisis, which was a 57, 58% decline. And then it regained. So there's a couple of things here that I want to highlight on this chart. One, the market spends quite a bit of time in a drawdown state. You can see that it spent all this time in a drawdown state, all this time. And you can see it doesn't spend all its time at a flat line. It's not spending all its time creating new highs. So there's typically periods where we're recovering from losses. They may be small losses, they could be large. The second point I want to highlight on this chart is that 10 to 20% drawdowns are pretty common. While at the beginning of the century here, we had these two big 50% declines, since then, we see 10% declines quite frequently here and here, here. Even 20% declines, we've had four of them over the last, 5 or 6 years. We had one in 2018, 2020, 2022, and last year in 2025. And drawdowns matter because they change outcomes. The deeper the drawdown, the harder it becomes to recover mathematically, as we talked about on the last slide, but also behaviorally. Investors usually don't abandon their strategies when the market's at new all-time highs. They're pretty content. They typically abandon them when the market's in a drawdown state. When losses feel real and your investors' confidence starts to break down, they feel this pressure to do something, to act, even when staying disciplined would probably lead to better outcomes. When I got started in the business, which was back in 2009, this was the reason why I got into the business. At the time, I was managing money for my mom and for myself, and we had all of our capital intact. We had a good risk management strategy in place. We were sitting around talking about her friends and my friends and how they were going to have to make some life changes. They'd have to work longer than they expected, had to go back to work or change the quality of their life. That's what got me into the business, is I thought I could really create some value and add value to people so they didn't have to go through those big life decisions. At the time, there was many stories of people who just bailed out of the market in March of 2009, right as the market bottomed. They just couldn't take it anymore, threw in the towel, and then the market bottomed and went back up. A few years ago, I was talking to an individual who actually experienced that. They got out of the market in late 2008, early 2009, stayed in cash from that point all the way through early March of 2020, when they were talking to an advisor, not myself, and they got back into the market the first week of March of 2020, right as the COVID crisis was hitting. These are the types of reactions that create permanent damage. Just this past year, I spoke to an individual who felt uncomfortable with what was happening during the tariff tantrum. If you remember last April, the market sank about almost 20%. This individual felt uncomfortable, even though their portfolio was down only 7, maybe 8%. They decided they couldn't take it anymore. They sold out. Problem is, they sold out about an hour or two before the Trump administration announced that they were putting a 90-day hold on the tariffs, and the market went up 10% that day. These are the types of behaviors that we want to avoid, and they're easily avoidable if we have a disciplined process in place. This is another one of my favorite charts. This is what we call a risk-adjusted return chart, or a risk-reward chart. The way this is designed is on the x-axis here, we have standard deviation. Standard deviation is simply a measurement of volatility. How much does an investment move up or down over time? The higher the value, the higher the volatility of that particular investment or index. On the y-axis, we have annualized return. This is how much return on an annualized basis that investment may have provided. I've plotted 6 different points here, some of the major stock market indices, a long-term treasury bond index, and a money market. And then I've applied what they call a regression line, is just simply a line that best fits these 6 points. And the reason I did this is it shows the relationship between risk and return. The more risk we take, the more return we might expect over a longer period of time. Now, not every investment is going to fall directly on that regression line. So I've drawn these 2 parallel lines, and the area between these 2 parallel lines is what I call the long-term expected return channel. Most investments, not all of them, but most investments are going to fall between these 2 dashed lines. And our goal as investors is typically to take a small step out on that risk scale and try to achieve as much return as we possibly can to get up and outside of that long-term expected return channel by targeting better risk-adjusted returns, or be up here in that upper left-hand quadrant. And this is generally consistent with most investors' desire for higher returns and lower volatility. And I assume that's probably applicable to most of you who are on this call. Now, there's one aspect of this chart that's really important. We can control risk, but we can't control returns. And let me use an example. We have the choice of where to invest our money. We could, if we decided to, invest our entire portfolio in a money market. If we did so, we would anticipate and expect very low volatility, close to zero. Money markets are very stable. Alternatively, we could invest our entire portfolio in the NASDAQ Composite Index. We would expect quite high volatility. However, during any given time, we would have no control over those returns. And let me use the money market as an example. During this long period of time, this chart goes back to all the way to, I think, 96. This particular money market provided about a 2% annualized return over that long period of time. However, if you've followed money markets recently, over the last several years, money markets were returning 4, 4.5, 5, or even higher, something we hadn't seen in quite a long time because the decade prior to all that, money markets were providing almost no return. So as you can see, we had no control over that return, but we could control how much risk we exposed ourselves to. I like this quote because it captures sort of the core of how we think about investing. Returns are an outcome. They're not something that we can directly control, as we just discussed. Risk, on the other hand, can be managed. How much risk we take, when we take it, how we respond when conditions in the market change. So our approach is built around that idea that managing risk thoughtfully is the most reliable way to improve our long-term outcomes. So remember that returns are the result and risk management is our decision. One of the harder lessons for investors is that the markets don't become risky when volatility rises. Volatility typically rises only after risk has already been built. Calm markets often feel safe, but historically they have proven to be periods where investors increase use of leverage. They may invest in more speculative stocks, and they may become more complacent, all while volatility remains quite low. It's only after these factors have built up underneath the surface quietly do we typically see that volatility spike. And by that time, it's typically too late to adjust your risk exposure. And that's why aligning risk with your tolerance during calm markets is so important. It's the only time investors can make clear, rational decisions about how much risk they're truly willing to live with. So once markets are under stress, investors don't reassess risk. They typically are reacting to losses. And that's when the discipline breaks down and permanent mistakes tend to happen. So let's use this time we have now while the markets still remain calm to reassess risk. Don't wait until volatility starts to spike again. So I want to shift gears here a little bit. As risk builds quietly during these strong markets, we need a disciplined process to help us stay aligned so that when the markets do become more volatile, we are prepared for it and prepared for those conditions to change. We want to do that now, not after that volatility has spiked. That's where our process comes in. So what I'd like to do is introduce the RGB investment strategies. We do not believe in a one-size-fits-all solution. Certainly different investors have different objectives. They have different time horizons, and they certainly have different tolerance for volatility in the market. At a high level, our strategies fall into 3 categories. We've got our core, which is really designed for capital preservation and stability. That's at the low end of the volatility spectrum. We have our Flex Plus strategy that is at the other end of the volatility spectrum. It's designed to participate in the equity markets and increase emphasis on risk management only during protracted declines in the market, some of the big bad bear markets. And in between, we have our balanced, which is designed as a blend of growth and stability. It really takes sort of the best from our core and our Flex Plus and intentionally combines them for investors who want growth without all that day-to-day volatility. Now, these strategies aren't competing ideas. They certainly don't compete with each other. They're different expressions of the same discipline for investors with different tolerances for risk. So we design these strategies around how much volatility an investor can realistically tolerate, especially during drawdowns, not during calm markets. So the next question really is, how do these strategies get implemented in, sort of real life? How are they applied to clients' accounts? So this first section up here is our qualified accounts. A qualified account is simply a tax-deferred or tax-free investment vehicle, typically used for retirement savings. They incorporate IRAs and Roth IRAs, 401ks, defined benefit plans. There are tighter rules around these types of accounts about what we can and cannot do. And because of that, the risk management portion of these strategies is driven, by positioning and exposure to the market and by our use of cash. And we implement those through our three strategies: they're core, balanced, and flex plus. Our core and balanced have a particular flavor, if you will, our core qualified and balanced qualified strategies designed for these types of qualified accounts. The other category is our non-qualified accounts. These are taxable brokerage accounts. They could be an individual, a joint account, a transfer on death account, which simply means that you can designate a beneficiary on your taxable brokerage account. Could be for an individual or a joint. Can be applicable to trusts, both revocable and irrevocable trusts. And because they're non-qualified accounts, we have a little more flexibility on how we manage exposure to the market. It doesn't mean that we're taking on significantly more risk. It means having more tools, basically, to manage those accounts more efficiently. The core and balance strategies may selectively use a concept called margin. It's applied very conservatively and within defined risk parameters. Our flex strategy, which happens to be the same strategy for both qualified and non-qualified accounts, does not rely on margin, but instead uses investment vehicles that help us get that additional exposure. The takeaway here really is that the strategy drives the risk profile and the account type determines how we implement that strategy in that particular account. So now that you've seen our strategies, the core, the balanced, and the flex plus, and the different flavors, as you will, for the qualified and non-qualified accounts, how does that translate in terms of overall risk exposure? So I thought this slide would be helpful to give you a sense of the risk profiles for our strategies, the RGB strategies, which are shown here in orange, compared to other funds, well-known funds, and market indices to provide some context around how much volatility our strategies actually expose our clients to. If we start at the top, obviously the Vanguard money market here on the top has the lowest volatility exposure. We have our two core strategies, both qualified and non-qualified. And then we have our balanced strategies here. And you can see these strategies have significantly less volatility than the equity markets. Even our Flex Plus strategy has less volatility than the overall equity markets when compared to the S&P 500, 600, even the NASDAQ Composite Index. So we're below those broad equity benchmarks. I've added in here a couple of other funds. The Vanguard Wellesley Income Fund. This is if you're not familiar with it, it's a long-standing, very conservative allocation fund. It's got a heavy kind of tilt towards high quality bonds and income, dividend paying equities. It's often cited as a quote unquote sleep well at night fund. But you can see it has much more volatility than our core strategies that are attempting to do the same thing. Even our balanced funds have less volatility than that Wellesley fund. The Vanguard Balanced Fund, this is a traditional 60-40 allocation, if you're familiar with that, 60% stocks, 40% bonds. It's a passive allocation fund, but you can see where that sits on the risk spectrum, significantly more volatile than our balanced strategies and even our core strategies. I also added in this iShares fund. It's what they call a minimum volatility factor ETF. It's a rules-based equity strategy. And I also oftentimes hear people using that as a defensive allocation. But I find it interesting that when I was doing this research, that it has actually quite significantly high volatility, pretty close to some of these equity indices. So although people are using it for defensive purposes, it may not be achieving what they're striving for. What's important here and the takeaway from this slide is that investors should select a level of volatility that they can live with, both in up and down markets. The goal here is not to abandon your strategy at the worst time possible, which is when the markets are going down. At RGB Capital Group, we're not trying to eliminate volatility, but rather we're trying to manage volatility as it translates into much more predictable outcomes over time. So the next question is, how do we actually manage that volatility? And so what I'd like to do is transition into our processes that drive some of our outcomes. I'm going to start at a high level, talk about sort of the just general framework, and then I'm going to dive into a couple of examples of how we manage risk in the portfolio. So we'll get a little more technical. We'll bring out a couple of charts, kind of dig into that a little bit. So as I mentioned earlier in the presentation, we don't rely on forecasts. We don't rely on predictions. We also don't rely on any single signal or indicator. Our process is driven by what we call weight of the evidence framework. What markets are very complex. Any single indicator can be wrong or noisy or misleading. So what we want to do is take multiple inputs, and when multiple inputs are aligning in the same direction, we've got a lot more confidence and conviction of where the market is going. So when several independent signals or indicators are pointing in the same direction, we're going to start to pay more attention. This helps avoid emotional reactions. It helps us reduce, the risk of acting on sort of noise. And when we do make changes, they're incremental. We're not all in, all out. For the most part, that's not how risk works in the real world. Adjustments happen gradually as the evidence strengthens or weakens over time. So this approach is really designed to reduce some of the ups and downs or whipsaws and keep clients invested through some of the more normal market noise. One of the important tools that we use within this framework is around following trends. And there's a specific tool that we use quite frequently, which is moving averages. Not because they predict the future, but because they help us objectively measure when the market behavior is changing. Let's dig into moving averages. Moving averages are simply a tool that helps us take the noise out of the stock market. On this chart, you see the S&P 500 in red, and this purple line is a 50-day moving average. That 50-day moving average is simply calculated on each day, looks back 50 days, averages those prices, and plots that particular value on that day. As you can see, it helps take out some of the noise. You can definitely visualize the trends. When the market was going down, that 50-day moving average turns down. When the market's going up, the 50-day moving average tends to bottom and go up. And you can just see it smooths out some of that noise. It helps us visualize what's happening in the marketplace. Now, where moving averages become most useful are with low volatility asset classes. And the reason for that is trends are more persistent with these lower volatility asset classes. One such asset class is what I call high yield bonds or high yield corporate bonds, or more commonly known as junk bonds. In this top panel here, we have the B of A Merrill Lynch High Yield Master 2 Index. It's just an index of the US domestic junk bond market. It's plotted along with its 50-day moving average. I'm going to point out a couple of features on this chart. Point A is where the market peaked. Point B is where the index crossed below its 50-day moving average. Point C is where it bottomed, and point D is where it went back up above its 50-day moving average. Now, because of the low volatility nature of these junk bonds, we can use these moving averages to help us make adjustments to our holdings. When the index is above its 50-day moving average, we want to be invested. When it drops below that moving average, we want to move to the sidelines, be in cash or money market. Now, if we look at this bottom panel, there's two lines here. The red, solid red line is simply a repeat of that B of A Merrill Lynch Master 2 Index. And this red and green line, which I call the composite line, is simply the results of making those adjustments that I mentioned above. One of the interesting factors and some of the compelling use of this is that volatility diminishes. It went from 2.7 down to 1.4 just by making those couple of adjustments. What's even more attractive and a byproduct of managing risk is that the returns went from 7.5% annualized up to 28.5% annualized. That's quite a big difference. So reducing volatility can actually help in our overall returns. If we expand the time horizon here, this window goes all the way back to the beginning of 2000. This is the exact same chart. We have the index on top plotted with its 50-day moving average. On the bottom, we have the index itself and the composite line. One of the things that you'll notice is this composite line was able to avoid these pullbacks in the market consistently. As a result of avoiding those pullbacks, we certainly have a reduction in volatility. It went from 1.46 down to 0.86, quite a considerable drop. And as a byproduct of managing risk, annualized returns went up from 6.5 to almost 9.7%. Again, this is very consistent with investor desire to lower risk and achieve higher returns, as we saw in that risk reward chart earlier today. Now, many of you who've followed me over the last many years, some of you have told me, oh, Rob's the junk bond guy. Well, I certainly like junk bonds. As I said, they're the epitome of a low volatility asset class. I also like them because they're a great barometer of the overall health of the stock market. But I'm not married or wed to junk bonds. They have served their purpose. They've served us well in our portfolios. Following the 2008 financial crisis, we were heavily invested in junk bonds, and that really paid off. However, there are other periods where there are other low volatility asset classes that are providing better risk-adjusted returns. For example, after the COVID crisis in 2020, there was a group of investments called securitized credit that provided phenomenal returns on very low risk. And that really provided for a fantastic year for our clients. I didn't take any more risk that year than I did any other year. It just so happened that the returns were being provided in that market environment. Today, we have a very small allocation to junk bonds. Instead, we're invested in other asset classes. And I want to show you why and how we've made that decision to move into these other asset classes. One of those asset classes is what I call the market neutral funds. Market neutral funds are simply investments or strategies that are designed to provide returns that are largely independent of overall market direction. Basically, they take some long positions and short positions that offset each other and tend to move up regardless of whatever the market's doing. We started investing in these back in early 2025. And the question is, why did we do that? Well, if you look at this chart, we have the market neutral index in red up top and compared to a junk bond index that I track in green. And the bottom panel here is a relative strength chart. It shows how one investment is performing relative to another. So if the red line is outperforming the green line, this line is going to be trending up like it is here. If the green line's outperforming the red line, it's going to be trending down. All that means is this uptrend means this red line, the market neutral index, is outperforming the green line, the junk bond index. And that is why we are more heavily invested in market neutral funds than we are the junk bond index. You can see we started getting in back here. You can see it started to move up with much less volatility and has continued to move up in that direction since that time. Another area that we've started to move into is emerging market bonds. Looking at this relative strength chart, emerging market bonds really weren't outperforming junk bonds by any means in 2023 and 2024. However, in 2025, you can see it had some rough periods. We got in around mid early June of 2025. And you can see this is what helps drive our decisions. Emerging market bonds in this current market environment are providing better risk-adjusted returns than junk bonds. So this relative strength assessment will help us decide which low volatility asset classes that we will be invested in. I'm always looking for better opportunities, and we'll make adjustments incrementally over time, so to keep in line with sort of the objectives of our strategies and the risk parameters of our strategies. And our process is always strives to achieve the best risk-adjusted returns that we possibly can find. And this is part of our process and how we do that. So I want to shift gears here. This is sort of the last section of our presentation this evening. Our process is designed to reduce emotional decision making, particularly during periods of stress. We also want to set clear expectations before those stressful periods arrive. So let's talk about how we work with clients and what our clients can expect from us over sort of a full market cycle. RGB is a fiduciary. Everything starts with our fiduciary obligation to our clients. We are both legally and ethically required to put our clients' interest ahead of our own. We don't have any product bias. We don't have any sales incentives. Our relationships with our clients are discretionary. That means that once the risk tolerance and objectives are established and agreed upon, we are responsible for implementing that on a day-to-day basis and making those decisions on our clients' behalf. Now, what's so important about that is that discretion only works if our risk tolerance is properly aligned up front, because the level of risk management we apply is driven by our clients' ability to stay invested through those more stressful time periods. We've talked a little bit about our portfolio construction. We use a disciplined model-based framework, 3 strategies that we discussed: our core, our balance, and our flex plus. Each one's designed clearly with a defined risk profile. And these are not static allocations. We adjust exposure, as we talked about, over time based on our process, but always within the boundaries of that selected strategy. The objective is not to maximize returns in any given year, but to preserve capital and manage downside risk, and then participate in the long-term growth in a very disciplined manner. Our fees, our standard advisory fee is based on the assets that we manage. It helps us align our incentives with our clients' outcomes. We do a little bit better when our clients do better, and that's good for everybody. For certain qualified clients, we also offer a performance-based fee option, which even further aligns our interests. If we get to that point, we can certainly talk about those qualifications. The common thread across all of this is alignment. We want to be aligned on our incentives. We want to be aligned in terms of our risk that we're taking, and we want to align our expectations. And that's what allows this process that you've seen today work over a full market cycle. So the next important question is, how do client assets where are they actually held and how are they safeguarded? As you can see on this slide here, Fidelity is our custodian. We use a division within Fidelity called National Financial. They are responsible for safeguarding your assets. They provide monthly statements to our clients. There's a broker-dealer involved called Syros Financial Services. They work hand in hand with Fidelity to set up accounts, make distributions, etc. Syros also provides me, or us, as the investment advisor, a trading desk. So when we're trading exchange-traded funds, more commonly known as ETFs, they have a trading desk that helps us get access to Wall Street and helps us make those trades as efficiently as we possibly can. So it's been a great relationship. This structure is very intentional. It separates responsibilities and duties and really protects our clients from things that can happen that could harm clients in the long run, but they can't happen in this structure. So we've talked a lot about our philosophy, our strategies, process, structure behind what we do here at RGB Capital Group. None of that would work without our people that are responsible for implementing it on a daily basis. So let me introduce the team. As you know, I'm Rob Bernstein, President and Head Portfolio Manager for all of our strategies. Ryan Redfern, he's our Assistant Portfolio Manager. He's on the call with us this evening. He's a chartered market technician. That CMT is a designation, and it just kind of reflects his deep technical skills and his deep understanding of the markets. That CMT designation is something that's pretty challenging to achieve. So it's quite an achievement for Ryan. Ryan and I communicate on a daily basis on the strategies, on our individual holdings, and the overall market environment. We're in constant communication about what's happening and whether adjustments need to be made in their portfolios. Lois, who you met earlier this evening, and most of you know, is responsible for some of our back office billing and accounting functions. She used to be more client facing, but we have, over the last few years, created our client services team that is now run by Stephanie and Hallie. They're both responsible for helping all of you with the onboarding process, making any administrative changes to your accounts, setting up the accounts to begin with, changing addresses, changing beneficiaries, making additional contributions to your account, or taking withdrawals or RMDs. And you'll find that they are super efficient. They get things done very efficiently, quickly, and accurately. So that's the team. I want to emphasize that this team the structure is very intentional. I've spent a lot of time building this structure over the years. All the key functions are not dependent on a single person. There's built-in redundancy around portfolio management between Ryan and myself. Our operations between Hallie and Stephanie, and even Lois can backfill some of that. And that sure ensures continuity for our clients no matter what happens. So you've now seen the people, the structure, the process, and the next question is really about fit. Not every approach is right for every investor, and we think that's a good thing. What matters most when it comes to these types of discussions is aligning a strategy with how you actually experience risk. Not how you think you should experience risk, but actually how you experience risk. So on this slide, I wanted to give you a few examples of the types of investors that we tend to work best with, and let you see where, if anywhere, you might naturally see yourself fitting into this process. So let's start with our core strategies. They're built for those who place a high priority on stability. Most of our investors in these core strategies are either retired or near retirement and place a high priority on protecting what they've worked so hard to earn. I've also wanted to highlight that we've worked with a lot of prospects who've come to us and they've had cash on the sidelines. Mostly the reason for that cash being on the sidelines is they were fearful to put it in the market. While cash on the sidelines may provide some sense of stability, you are losing purchasing power because that money is not working for you. And as costs rise, that purchasing power of that money on the sidelines is diminishing. So these core strategies were originally built around my mom's needs, as I mentioned earlier, and have proven to fit many of our investors who've worked so hard for their portfolios and their net worth, and they just don't want to see that evaporate in the overall stock market. Moving on to the balanced strategies. Again, this is investors primarily who are retired or nearing retirement. They value growth to support income, but don't want that growth to come sort of at the expense of losing sleep at night. They value that stability while still need that growth potential to support their living. Lastly, our Flex Plus strategy is typically used by our younger clients and clients with a longer time horizon. All of our clients in our Flex Plus strategy are much more comfortable with normal market volatility. As I mentioned before, the Flex Plus strategy is really designed to manage risk around those protracted bear markets. So normal day-to-day volatility is something that you would need to be comfortable with. I did mention that both the core and balanced strategies are appropriate for retired individuals or individuals who are nearing retirement. The difference between these isn't about age. It's how much volatility these investors or clients can accept once you know your income and lifestyle needs and how those are dependent on your portfolio. Most investors don't fit perfectly into just one of these boxes. In practice, many of our clients have funds in different strategies depending on the account type, on their time horizon, their needs for those funds, and any income needs. So I'd like you to think about whether those may fit for your particular situation and whether we could add value to your overall financial plan. What I'd like to do is wrap up. Ultimately, investing comes down to choosing how much volatility you're willing to live with. Our role is to help our clients choose sort of a smoother path forward and to be able to stay on that path regardless of what the market might throw at us. Our top priority has always been and always will be to protect capital from life-altering losses like we saw over the last 20 years. It's happened many times. And those declines is what creates bad decisions, typically. All of our decisions are guided by a disciplined process. We're not subject to headlines, news articles, but rather we're data dependent. Our interests are aligned with our clients. All of my personal money, Lois and my personal investments, investable assets, my mom's investable assets, my sister, my cousins, are all invested in our strategies right alongside yours. Ryan's got money in these investments, in these strategies. And so what that means is we're not asking you to take on any risk that we're not willing to take on ourselves. So we have meat in the game, if you will. Our goal is to provide confidence and peace of mind in both calm markets as well as difficult markets. Our goal is to allow you to do the things you want to do, spend time with family, play tennis or pickleball. I know there's some pickleball players out there, travel, and not worry about your investments. If any of this resonated with you, there are ways to continue the conversation, whether you're a current client and want to revisit your strategies and your allocation, or you're someone who's just here learning about what we provide. Please schedule a introductory 15-minute call if you'd like. I think Ryan or Lois is going to put a link into my calendar in the chat. We also provide a newsletter that's produced every week, every Monday. It's a one-page, quick, easy read. It helps you understand what we see happening in the market, what changes are taking place, and how we're adjusting to those changes as they happen in real time. Ryan will also share a link to subscribe to that newsletter if you're not already subscribed. Lastly, we ask you to complete a brief survey. We certainly value your opinion on how we did this evening and would appreciate you taking time. You can also sign up for that newsletter and that survey so you don't have to do it twice. With that, thanks for your attention this evening. What I'd like to do is open this up to questions.
All right. Question about market neutral funds. A couple of them came up. One was relating to volatility. Do you find them volatile versus other asset classes? And I'll just hit with that first.
Okay, so the question is about market neutral funds. Do we find them volatile relative to other asset classes? As I mentioned before, junk bonds to me are the epitome of a low volatility asset class. And you can see that here in green. This red line is an index of large market neutral mutual funds. You can just visually see, although we don't have the metric on the screen here, there is very low volatility in these. And the reason for that is what I have found is many of these market neutral funds are uncorrelated to each other or have very low correlation. So while one goes up, the other goes down and they offset each other. But if they're both over time moving from the lower left to the upper right, it provides a nice low volatility uptrend. So what I found is these market neutral funds actually, when combined and used together, provide a very low volatility return stream for us. And that's what makes them so attractive.
Nice. And another asked for an example of a market neutral fund. I'm not sure if you want to go down that or not. I know this is a composite of several.
Yeah. What you're seeing here is a composite of several funds. I hesitate to provide any one specific fund because what we do is we track these funds on a daily basis. And I may tell you my favorite fund today. That may change tomorrow or next week based on market conditions. But you certainly can do some research out there and find market neutral funds that meet criteria that satisfy your objectives. And that's really important. I could share a fund with you, but it may not be appropriate for you. The funds we select are appropriate for our strategies because they meet the risk and reward characteristics that we're looking for and are compatible with the strategies and fit in with our risk parameters.
And then back to your volatility versus index chart. There
Yes.
were a couple questions on what you were calculating here, and I believe it's annualized volatility. And what time frame are we looking at?
Yeah. So this chart, it's a really good question and something I really should have addressed. So I think the question here is volatility. This is not an annualized volatility number. This volatility number is actually a monthly number. Technically, it's a calculated based from a daily standard deviation converted to monthly. So if you compare this to what you might see as an annualized standard deviation, you will see a difference. Think of this as a monthly standard deviation. I hope that addressed the
Mhm.
question.
No, did for me as well. So thank you. And it looks we're looking at 5 years here, I believe, since
This
2020.
is a
Yeah.
this is a 5 year chart. So this is the standard deviation, monthly standard deviation
Mhm.
for each one of these over the last 5 years.
That's post COVID crash, but that does include the 2022 correction year.
Correct.
Awesome. Um, this is asking about how quickly you can react to a sudden loss of 20% or so. I'm not sure if that's makes sense or I'll let you address that if you can.
How quickly can we react to a sudden major loss of 20% or so? So again, it depends on the strategy. Our lower volatility strategies, particularly our core and our balance strategies, are designed so that we're not going to experience the types of losses that you might typically see in, let's say, the S&P 500. I think I showed a chart earlier, the drawdown chart, where it showed the S&P 500, over the last, I think it was 5 or 6 years, had 4 or 5 20% drawdowns. We're just not going to see that because of this lower volatility nature. The portfolios and the investments that we use within these portfolios just don't have that same level of volatility. So I talked about junk bonds being the epitome of a low volatility asset class. That nature, that trend persistence, and their ability to trend in one direction, and when they trend to change directions very slowly. And that gives us ample time to make a rational decision, to make adjustments to those holdings, as opposed to a more emotional or reactionary change in a higher volatility investment like, say, the S&P 500. So we typically don't see that type of situation. Can't say it's not possible, but I haven't seen it in the 16 plus years that I've been working in this business. I think it's unlikely. Now, that could be very different in our Flex Plus strategy. As I mentioned before, this is designed for investors who are much more in tune and willing to accept that day-to-day volatility. Our Flex Plus strategy, as I said, is designed to manage risk through protracted bear markets. We're going to lean into and lean out of the market depending on the indicators and the signals that we get. And as that weight of the evidence points to a more depressed market, we're going to kind of lean out. As things improve, we're going to start to lean in. So certainly we could see a 20% decline in that Flex Plus strategy. Certainly is possible, but we're going to try to lean in and out of those. Because of the higher volatility nature of the Flex Plus strategy, we try to get it mostly right most of the time. We're not going to get every dip in the market 100% correct. But if we can get mostly right most of the time, that will certainly provide us some financial stability over the long term.
And if you don't mind me adding, what I think is interesting is big drops like that don't tend to happen out of nowhere. There's usually things leading up to it, and you'll see problems building in data that we look at well ahead of time. So, and you even see in the high yield bond category, you see it rolling over before it picks up speed, and that's one of the good places and a key place to watch. So,
Yeah.
hope you don't mind me adding a little bit there.
Oh, no, please. Appreciate the input.
All right, question on emerging market bonds and currency risk. Is that risk hedged or no?
It depends on the funds that
Mhm.
we're using. Right now, the local currency funds in the emerging market space are actually doing extremely well. Some of the funds that we're invested in are hedged. Some of them are not, and so certainly you could see more volatility in those that are not hedged. But right now, they're doing extremely well. They're providing extremely low volatility return streams, and they're attractive. Once that changes, we'll certainly make adjustments and lean out of those. But for now, we're certainly enjoying the ride.
Another question was kind of how do we anticipate breakouts? I think that's very similar to how we anticipate market corrections. Anything to add on that?
Yeah, it's really looking at the data. It's looking at the charts, leaning into our weight of the evidence framework. Try to, again, let the data tell us where the market's going. Try to avoid the noise, headlines and the narratives that are out there in the news. Those are all distractions. And so if we can focus on the weight of the evidence, we use trend, we use momentum, we use breadth, we use volatility measures to track the market. And once all those indices or all those signals tend to point in the same direction, you have a lot more conviction and confidence that, yeah, the market's sort of tipping in that direction. So if it's going from a high and things look like they're deteriorating, we're going to lean out of that market a little bit. Doesn't mean the market's going to continue to go down, but we're going to use that data to start to lean out. And when we see it come back after a correction, we're going to start to lean back into those markets. So it's really data dependent. Ryan and I track a number of indicators that help keep us in touch with what's happening in the market.
Do you think market risk is enhanced right now when the financial sector is doing poorly? I don't know if it's doing poorly, but it's certainly having a rough week.
Yeah, I guess you could say maybe it's enhanced. Again, that's volatility, right? What you're seeing now is volatility. The risk is something that's probably was built up quietly in the past. Seeing one sector roll over could be for any number of reasons. Typically, when we see high risk, high volatility in the markets, we see everything starting to roll over at the same time. And we're just not seeing that in the marketplace right now. As I said earlier, we've got small caps and mid caps that are starting to outperform. Technology, has been leading for many, many years. And we haven't seen small caps break out for a long time. So it's kind of fun to see small caps finally start to participate. Doesn't mean I'm anxious to jump in. It's been a difficult asset class to be involved with, but it just shows that there's a rotation out of one sector into another sector, and that's healthy for the market. So I don't see a lot of volatility or underlying risk in the market right now. That could change next week, but right now things still look pretty healthy.
Nice. Everyone's asking if we've ever been out of the market in a money market cash. Very simply, yeah, often. But how often?
Yeah, how often? We don't like to be in cash, but it is a fantastic tool to manage risk during big bad bear markets. During the 2008 financial crisis, we were heavily in cash. During the 2020 COVID crisis, our core strategy was in cash. It wasn't in cash for very long. It was a very quick turnaround. We were out of the market by early March. We're starting to get back in the market by the end of March. But cash was a great tool. It was the best performing asset class during that period. So yeah, so we certainly will use cash to manage risk when appropriate, but it doesn't happen all that often. It generally happens when we see these big bad corrections happen, and we will move to cash if necessary to protect our clients' assets.
Nice. I will ask. There are a couple of people have asked what the AUM of RGB Capital is, if I may ask.
Yeah. So currently we manage about 86 million in AUM.
Cool. Thanks. There are a few questions about wanting specific funds. I would suggest getting on a call with Rob, and he could probably give you real life examples. I could as well, but I would lean into Rob on that. If you want to look at like monthly standard deviation of the funds, I think that's a Rob question as well. How about what part of foreign stocks and emerging markets play into your allocation?
Well, we're talking stocks now.
Yeah.
Yeah. So we talked about the debt side. We mentioned that we're in emerging market debt, developing markets debt. On the stock side, right now we are 100% U.S. focused. I know a lot of the foreign markets are doing well. I'm just not convinced quite yet that's going to be a long-term trend. We're still showing some great trends here in the U.S. We've got exposure to large caps. We got exposure to technology. We got exposure to value stocks. we're pretty comfortable with where we are and don't have any emerging market equity exposure as of today. Could change, but
Mhm.
as of today.
Do you consider tax implications when deciding which funds to buy or sell?
Good question, and certainly a fair question. Taxes are certainly important, and they are part of the overall financial equation. However, we prioritize capital preservation first over tax consequences. Moving to cash and being exposed to some tax liability is certainly less detrimental to our overall financial health than experiencing a 30, 40, or 50% decline in our portfolios. So, with that, taxes are important, again, secondary to our overall mission and goal of managing risk in our portfolios.
I
Yeah.
think that's about it on questions. Anything you want to do to wrap it up, Rob?
Yeah. Thanks, everyone, for attending this evening. Appreciate your time. Hope this was a valuable experience for you. If you did have questions that we weren't able to answer, and I will take a look at those questions and get back to you, within the next week. And if we could have if those require a conversation, we can certainly schedule a call. If it's something I can address via email, I will. But thanks everyone for attending this evening, and have a great evening.